Hello and welcome to simpleroptions.com. My name is Don Kaufman, and this weekend, today being August 23rd, 2015, I wanted to do just kind of a special volatility type video, really for all of our clientele here at Simpler Options, given the fact that obviously the volatility the prior week has got really many of our clientele a little on edge, and I'm going to spend just the next 10-15 minutes trying to really kind of bring you up to speed in what you can do effectively in volatility and where you really need to be concerned, in essence, in managing your risk. And we're going to look at this from a few different perspectives here. So let me jump into it. Unless, of course, you're hiding under a rock somewhere. We saw some fairly extreme levels of volatility, and this, in terms of trading volatility, that's really where I've made my career in trading. I started trading in the late 90s and hit a patch of volatility, 3 weeks after I started trading in Chicago. And it's, again, I've really made, myself in terms of heavier volatility trade, everything from 98 to 2000, 2001, when I was managing risk for a firm. Then of course I joined on the Thinkorswim team, was there 2007, 2008, 2009. But as a trader, I've always fared most effectively in the most volatile of times. And really, if you can think clearly through these times, this is when you can not only survive, but you can thrive in essence, in heavier volatility, because in heavier volatility is where opportunity ultimately exists. But if you can't handle the risk that you currently have on, you're not going to be able to function, and execute in the heavier volatility. So let's start with not necessarily looking at a chart. We'll go over to the charts a little bit later over here, but at this point in time, given what we saw, for instance, last Thursday, fairly large down day in the S&Ps, and I got to tell you, on Thursday, having a little fun with it. We're down big over there, nothing too crazy over there. Friday, it got serious. There's no question about it. It was the fifth largest move, ever recorded in the volatility index. The volatility index now sitting at the 28 level on a percentage basis. The fifth largest percentage move, in the volatility index. That's why I say it got a little bit serious. But what does that really mean for you? You got to put this thing into kind of brass, tacks over here. First thing we're going to look at this evening is we are going to go to the SPX. I'm just going to tighten up the number of strikes. Whether you're on Thinkorswim or not, it's neither here nor there. The at-the-money options, all the options, set the money, out of the money, in the money, volatility has exploded. As such, the short duration options, that's right. We're sitting at roughly a 47% volatility. I know the VIX, but the VIX is the 30-day implied volatility. The VIX only got jacked up to 28. Short duration volatility has exploded in our faces. We're at a 47, volatility, which is equivalent in the next 5 trading days to a $92 plus move up or down. Now that's what's expected. That's a 68% chance of being in this range. However, if you looked at last week's expected move, and this is where this stuff gets kind of interesting over here. I'm actually going to go into think back, which is what? It's just end of day data. Here we are on the 23rd. I'm just going to move to last Sunday to make a point. And last Sunday, the expected move was $26. Yeah, we exceeded that just by a bit. If you now take a look over at a chart, here's the move last week. We moved from 2100, to 1970. So in terms of a point movement on the SPX, let's do some rough and dirty math over here. It's a 130-point move. 130-point move. Wait a second. For a 4-day expected move, and this was a primary expiration, a 4-day expected move, it's about a $26 move. If I use the spiders in this case to get the full week, the full 5 days, the full 5-day move, okay, inside of these spiders was about close to almost $28 equivalent to the SPX. We did over a 4 standard deviation move last week. Okay, that's getting serious. For those of you that are into the statistics over there, 4 standard deviation doesn't happen very often. Okay, in fact, you can only say you've seen that a handful of times in trading. When they happen, though, they're extreme moves. Back to the SPX over here with a $92 expected move. Right off the bat, you have to start thinking, instead of just $92, you got to start thinking in more or less percentage terms. Okay, now again, I want to stay away from a chart. I just want to stay away from the chart, and I want to bring you into the Analyze tab of Thinkorswim, and I want to bring the reality of a move to you. And to do that, what you're looking at right now in Thinkorswim, you're looking at a risk profile. Now, everybody's like infatuated with risk profiles. Ooh, it looks like a big distribution curve. Don't worry about it. To me, one of the most important things, okay, is that over the next week, and this past weekend and Friday afternoon, you have been bombarded with what the market is going to do. It's not the end. It is the end. It could be the end. It's the beginning of the end. And the reality is, once you're in the throes of volatility, okay, throw all the commentary out the window, because that's all it's good for. It's every man, woman, and child for themselves in the marketplace. I have some friends that work in the Chicago area for some very large derivatives firms. They're doing, okay, what I'm about to show you this entire weekend. They've been going through what they term their risk array, and they've been plotting and planning and saying, like, hey, if we move up 6%, if we move down 6%, what that might look like profit and loss wise. They're also coming up with like little battle plans. Okay, one thing you have to realize is, regardless of what you think is going to occur this week, it doesn't matter. Are we going to rally back up? Absolutely. We're going to see some rally at some point this week. Okay. However, traders may sell into the rally. It doesn't even matter where the futures open. You know, I was thinking to myself earlier, and I was like, ooh, I should wait for the futures to open. And I thought to myself, no. Okay. In all seriousness, if the futures open down, there's a pretty good chance that in the middle of the night they capitulate and rally back up. If the futures open up, then I'm a little scared, because if they open up, that gives traders a reason to sell, okay, into any up move. Again, it doesn't matter what any of us think is going to occur this next week. The answer is yes, it's all going to occur. All you can do at this point is you can plan and plot your risk. Now, what does a 3% move look like? Now, a 3% move, that's exactly what we saw last Friday. I'm not saying another 3% move is going to come, but if you don't know what it looks like, profit and loss, okay, that's going to be a painful situation. So what this risk array is designed to do is to show me everything from a 3% down move, a 6% down move, a 9% down move, a 12% down move, a 15%, and vice versa. It's going to actually show me my upside potential, okay? And I've taken all of my positions, and I have positions in TD Ameritrade and Chipotle and Costco and Microsoft and on, and SPX and the XLF over here. It doesn't matter what some of my individual positions are. It really doesn't. You want to see my XLF position? Look, I'm short 7,100 shares of the XLF. Dun, 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 dun. Doesn't matter. Okay? It just doesn't matter. All that matters is the conglomerate portfolio beta weighted of this position. This is likely what I'm going to make or lose. This is today. What's it going to look like tomorrow? Tomorrow, we go down 3%, I'm going to make 14 grand. We go up 3%, I'm going to lose 14 grand. Okay? The only differentiation in here is I've got a ton of positions in the SPX, and with all those positions in the SPX, I'm going to be very sensitive to changes in implied volatility. And you can take your implied volatility. You could say, what happens if implied volatility went down 15 full points? I mean, that's what it went up. Look at the profitability. But then you have to say, what if the volatility went up 15 full points? Okay? And you can look at your positions, again, in both kind of spectrums over here, where what if we go up? What if we go down? If you don't throw out possibilities, Okay, let's move volatility up 15% now. That's an extreme move. You're like, oh, Don's position is getting killed. You better believe it. Okay? But I'm planning it and plotting it now. And this is something you should just do with your portfolio. Again, regardless of what you think is going to occur. Good risk management, you don't think. You know. It's playing the game of chess 5 moves into the future. So that's really what a risk array can do for you. And, just on this evening's video, I don't have time to go into every single detail of a risk array over here, okay? But more to come. Now, let's go over to our charts. Let's go over our charts over here, and let's actually take a look. This is the last 9 months. Okay, in the last 9 months, we're pretty much at the lows for 9 months, but let's zoom it out a little bit. Let's go look at the last year. All right, the last year, well, that was kind of an ominous move back here in October. We all kind of remember it, but it didn't have the fast and furious move down. By the way, with volatility, if you think these fast and furious moves down, okay, wait until we actually have an oversold situation when we rally up. When we rally up, okay, that's going to be a rally. If you're short, it is going to take your head off. This is what I'm trying to explain with volatility. Any short duration, choppy moves that you're going to make, meaning like, hey, I think we're going to go down, I'm going to buy puts, or I think we're going to go up, I'm going to buy calls. Every one of those short-sighted trades, okay, you're going to get your head clipped off. Because at this point, again, it doesn't matter what you think is going to occur. It just matters that, hey, we're in the throes of volatility. What drives this? This is where fear really starts to kick in. I mean, this is where the psychology of the market kind of grips hold. And the answer is, hey, unless you can quantify psychology out there, good luck. That's why really it truly is some of the most unpredictable times of markets. But it provides this incredible opportunity because option premium is jacked up. The option premiums are through the roof right now. But again, here we are in a 1 year, but I just want to take you and put it in perspective. Now let's look at it in a 3 year. Usually when I look at a 3 year, I think to myself, holy, you fill in anything you want over there, because this is a much more ominous looking picture. There's no support in here. I mean, we've had one of the most staggering moves to the upside. And even further, I'll flip it to a 5 year, and you figure to yourself, well, the last bout of real volatility we saw, I got to zoom all the way into, ironically, August of 2011. Don't tell me there can't be volatility in August. That's the last extreme volatility that we saw. Okay. Now, again, doesn't matter so much whether we go up or whether we go down. I find that typically when markets get volatile, and this is 15 years of brokerage experience at both Thinkorswim and TD Ameritrade speaking, people have tendency to do all the wrong things at the wrong time. The one thing I'm going to give you right now, if you think we're going to rally and explode to the upside, don't buy calls. Do not buy calls if you think we're going to explode to the upside. Because if we do explode to the upside, in comes the volatility crush. They are going to suck the volatility out of these options like you have never seen before. And I'm just going to give you for example here. What we're looking at right now is a theoretical pricing calculator. Just giving you like theoretical price, but I just want to show you briefly what I mean by volatility crush. Let's say vol gets crushed by 10 full volatility points. Okay, the option that you bought one day for, I don't know, $35, $37 over here, it's going to be worth $19. It doesn't matter if the market goes up. The volatility is your enemy. Okay, I could move the market up a full 10 points. Heck, I could move the market up 50 points. I move the market up 50 points, volatility is going to come off even further. Don't buy calls if you think we're going to rally. Even in the money calls. Even in the money calls are going to suffer vol crush. Okay, watch out for volatility crush over there. If we move down, sure. People say, well, if we move down, Don, I could buy me some puts. You could buy puts. But if we don't move down, look how expensive these puts are. If we do not move down, if we stay flat, even rally up a couple of bucks on the SPX, spiders, heck, I can look at Apple. Apple's got the same situation. Apple's volatility in the short duration went to 67%. It's a $7 expected move. Vol is jacked in there. You realize if Apple goes up, if Netflix goes up, if Google goes up, it doesn't matter. Okay, what's going to happen is volatility is going to go down. So if you buy puts thinking this market's going to continue down, the moment you buy these puts, if we stay flat or go up, your puts are going to get crushed because the vol is going to get sucked out of them. If we go down, sure, the puts might be worth a little bit more, but then what's called skew is going to move against you, and it goes on and on. You kind of feel like you're doing everything wrong in a more volatile market. Now, I'm going to talk about what you can do and what can be done right. In the shortest duration, falls at 47%. It's a $92 expected move. Has anybody taken the time just to open up? Let's just open up 120 strikes. Let's get crazy. These are weekly options. Weekly options. There's options all the way out here at the 1700 strike. That's right. We're still at almost 2000. The 1700 strike with 5 days remaining that are still trading for $5. You sell premium out there. And I'm not telling you to sell it naked. Sell premium in a defined risk manner. Okay? It's all about risk reward from there. But the premium selling opportunities in the coming days, okay, to be afforded to you are incredible. Okay? And I'm just going to take you now purely into my SPX position because I've been nibbling a little bit. And what do I mean by nibbling? This is my live position in the SPX. Look at this. I never traded anything more than one contract. I am captain one lot over here, but I got a lot of one contract trades. Okay, and all of these, and some of them, yes, some of them have sold naked. Okay, I'm swinging out there in the breeze, but in the end, I'm generating, okay, in just my SPX position. And these are live trades, live positions on here. In the end, my positions are generating, okay, how much per day? Well, let's go over here and reset the parameters so we're all clear. Just my SPX position is generating $822, okay, in theta. Not big. I'm only nibbling right now. What's that position going to look like just 3 or 4 days from now? I'll actually simulate it out. A lot of the theta comes out of it. Okay, helps the P&L drastically over there. As the week progresses, I'm going to actually continue to look for premium selling strategies. And you can see I've sold some of the shortest duration premium. I've sold some SEP1s, some SEP2s, okay, some SEP4s, a little bit of ACH. I'm just distributing capital all over the place. Okay, it's a party if you know how to handle your risk over there. With that, I have received dozens and dozens of emails over the last approximately 48 hours, hence this video here. And as such, I've actually put together a class. I've had the class ready to go for quite some time, waiting for some volatility over here. I'm going to do a class. I'm going to do it this Wednesday. This Wednesday, okay? And this Wednesday, for those of you that are not aware, it is August 26th. It's going to be 8 p.m. Eastern Standard Time. Survive and thrive in extreme market strategies and hedging to combat volatility. The link for it is simpleroptions.com/risk. Again, simpleroptions.com/risk. I'm going to actually talk about the opportunities. Okay, I'm going to talk extensively about risk mitigation. If you can't handle the risk you already have on, and we're going to look at your 401k and your IRA. If I could just save you guys just a couple of percentage points, it's totally worth to go to the class over here. You know, and I've done some previous sessions about volatility, but now we're in the throes of it. Okay, and now we have to actually look, are you exposed? The risk array that I discussed, I'm going to show you how to build a risk array. Even if you don't have Thinkorswim, I'm going to show you how to build a risk array, okay, specific for you. And you're going to include your 401k, you're going to include your IRA, and your short duration trading account, how to prepare for the volatility crush. We are going to crush in volatility. It just might not be Monday, Tuesday. At some point this week, we're going to see these wild swings of the VIX, wild swings of the volatility futures. That is what we kind of prey on. That's where you can actually thrive in much more extreme markets over here. Again, the class, it's only $97. It's coming up this week. I threw it together here a couple of weeks ago when I saw some volatility kind of rearing its head in late June, early July. And now I've actually got everything set up. We are going to talk some iron condors, but it's going to be a very different iron condor than maybe I've discussed before. We're also going to discuss hedging techniques. Okay, does buying puts really work when the VIX is already spiked to 28? Like, what's the point? Okay. And hopefully by Wednesday, what's actually occurred is volatility's backed off a little bit. Just understand that you're in the throes of volatility right now. This kind of stuff isn't just abate overnight. Now we're in it. Could take weeks, even months, to come through what is going to look like a more volatile market with an expected move of $92+ in the front month. Spend the time, okay? We can just save you, again, a couple of percentage points in your portfolio here or there, all right? I'm even going to talk a little bit about how to most effectively execute trades when it's volatile. It's not easy when the world is just firing into markets and seeing extreme volume out there. With that, I want to thank everybody for joining me this evening here. And hopefully many of you will see at this class here on August 26th from 8 to 10 Eastern Standard Time. Suffice to say, I'll probably go a little past 10 o'clock over here. I got a lot to cover in that 2-hour window. Thanks a lot, everybody, for joining us here at simpleroptions.com. And check out simpleroptions.com/risk.